In today's video, we're going to be backtesting the Golden Cross trading strategy in the S&P 500 going back almost 20 years. If you're unfamiliar with what the Golden Cross strategy is, I'll share a quick TLDR about it, but we're going to spend most of our time running the actual backtest. We'll be using our free moving average crossover backtester to run this backtest and go through the results together. I'll leave a link to download this backtester in the description box below. It's a completely free download, so you can download it and follow along in markets, not just the S&P 500, but also the personal ones that you care to run this backtest on. Now, at the end of this video, we'll try and answer the question, well, were there any surprising takeaways? We know in the long run, the market goes up, so we would expect our long side backtest to be overall positive. However, is there anything else that we can take away from running this exercise? Now, if you're unfamiliar with what the Golden Cross trading strategy is, it's quite simple. We're looking for times where the 50-period simple moving average crosses above the 200-period simple moving average. If we look at an example on the charts, this is the 50-period simple moving average. The pink line is the 200-period simple moving average, and you can see when that cross occurs, that's what we define as the Golden Cross. You can also see the backtester takes a trade setup after that Golden Cross occurs. So this is how to read not only the backtester, but also the actual Golden Cross opportunity. Now let's jump into Thinkorswim and start running this backtest together. These are the settings that I'm using for the backtester. I've set the long entries to true since we're going to be testing longs first. I have our fast moving average length set to 50 and our slow moving average length set to 200. Both moving average types are set to the simple moving average. Now if we click OK, apply, I have a chart of SPY loaded on going back 20 years. If you want to test a different market, simply change the symbol and the backtester will adjust and work for whatever market you're looking at. Now coming back to the SPY, if I right click anywhere where we see this purple report, let's analyze our backtest report for this long side Golden Cross trading strategy. Over 20 years, we've had a total of 9 setups that have triggered. So that's not a whole lot of times that the Golden Cross has actually triggered. Out of those 9 times, if we count the number of losers, we've had 1, 2, and 3 losers. Now this loser back in 2010 to 2011 was a fairly small loser. These other 2 were slightly larger. However, if you compare some of the wins, you can see that the wins are much larger. The win from 2022 to 2023, which helped you catch much of this rally, a very nice winner. Same thing in 2016 to 2018. Same thing in 2012 to 2015. So the strategy does give you winners that are much bigger than the losers when you do have losers. That's the power of the Golden Cross strategy and using moving averages, which don't really trigger a whole lot, 9 times out of 20 years. Now, if we take a look instead of the Golden Cross strategy, what happens if we try and play the reverse, the Death Cross strategy? This is where we're looking at short side setups anytime we have a crossover to the downside. That means the 50 is crossing below the 200. So if I set now our short entries to true and we click OK, let's run this backtest. We can see here the P&L histogram very clearly negative. This is telling us that it's not a good idea to be shorting every single time this death cross happens. In fact, it's a little too late. If we analyze the backtest report, we can see 10 total death crosses over the past 20 years. Out of those 10 death crosses, only 1 and 2 of them have actually helped you catch any kind of winners, and the most recent one was actually not really a very big winner. In fact, the losses are much bigger here. The one large winner was the 2008 crash, and that would be self-explanatory in terms of why this cross actually worked. So our takeaway here that we might pull with our death cross is by the time the death cross occurs, it's a little too late to be shorting the market. In fact, you might be looking at places where the pain is almost over and we're looking at the long side to pick back up. After all, that's what the backtest suggests here, that shorting when the death cross occurs is not a profitable strategy. So this is how to use our moving average crossover backtester to very easily answer the question, well, does the Golden Cross strategy work? And we very clearly answered that question as a yes. Here we saw we had a total of 9 different setups over the past 20 years, and 6 out of these 9 were winners, and we also saw that the winners were much bigger than the losers. The exit here that we're looking for is when the moving averages cross backwards, so the 50 crosses below the 200. That's when we exit our long side setups. We then reversed and we took a look at the short side entries where we measured the death cross instead. This is where we looked at shorting every single time the moving averages crossed below one another. We saw the death crosses didn't really give us a positive strategy, and the one surprising takeaway that we might have is the death cross is actually a better predictor where the trend is getting pretty dang close to ending and reversing, as opposed to a predictor of more pain ahead. At least that's what the backtest suggests. I hope you found this video useful. Again, you can download the Moving Average Crossover Backtester for free on our website. That's tosindicators.com/backtesters, and there look for the Moving Average Crossover. Take care, everyone. Good luck trading, and I'll see you in our next update.